Hello, welcome back to Learn Economy. In this video, we are going to look at the automatic stabilizers. These are features of tax as well as transfer systems that would temper the economy when it overheats, and this would stimulate the economy when it slumps. So whether it is negative effect or whether it is positive effect, this is without any direct intervention by policymakers. Automatic stabilizers would offset fluctuations in economic activity without any direct intervention by policymakers. These are actually certain types of government spending or revenue kind of procedures taken by the government, which are considered to be very much sensitive to changes in economic activity, to the size as well as the inertia of the government very generally. A short-term cyclical deterioration in the budget, this should be reversed as economic conditions improve. Fiscal actions that require no action and will occur automatically based on the current phase of business cycle. The most common automatic stabilizers are considered to be the progressive tax system as well as transfer payments. A common example of automatic stabilizers is corporate and personal income taxes, which are considered to be more progressively graduated, which means that these are fixed in proportion to the income level of the taxpayer. We know that the government has fixed certain slabs, and this is fixed, and as per the slabs and as per the income you earn or the income you have or the income you receive, you will be paying the income tax, right? So this is considered to be one of the common example of automatic stabilizers. Other examples would include transfer payments such as unemployment insurance, welfare schemes, stimulus checks, etc. Automatic stabilizers, whether it is in the form of taxes or it is in the form of transfer payments, this would cushion the impact of recessions on people, helping them stay afloat if they lose their job or if their business suffer. So they also play a vital macroeconomic role by boosting the aggregate demand. If it this is actually, we are talking with reference to the welfare schemes and all that the government would be spending for the public. For example, the pensions, which is a kind of transfer payments. If you get pension, especially during recession and all, that would happen to be a very big relief. So this will make the downturns shorter and very less severe than the case otherwise, right? Automatic stabilizers would include, as we have already told, unemployment insurance, food stamps, etc. Suppose aggregate demand were to fall sharply so that a recession has occurred. Relying on automatic stabilizers would provide certainty to the economy and economic actors if there is a downturn, support would be provided by the government, reducing the time policymakers need to spend on basic stimulus and aid to impacted individuals during a downturn. Because if there is some kind of a problem happening in the economy, the government has to realize this problem, the government has to study this problem, the government has to understand the problem, analyze the situation, and then the government would the government as an overall body would constitute a meeting and they will discuss, and what they do is that then they will frame for a policy and it will take some time to implement the policy, which means that if you consider the occurrence of the problem on one hand and the implementation of the policy in order to deal with the situation on the other hand, between these two events there is a lag, there's a time lag. So it's very important to consider that time lag. During recessions and all, the automatic stabilizers tend to increase the budget deficit because the government might not have enough money with them. So as a result, what it does is that it should borrow from somewhere, right, in order to finance this expenditure. So if the government was instead at full employment, the deficit should be reduced. Especially the deficit is reduced by using the taxation policy. By increasing the level of taxes, the deficit is reduced. Automatic stabilizers would respond to changes in the economy quickly, even though that quickly you have to take into consideration the lag of time that is required between the happening of the problem and the implementation of the policy and the effect created by the policy in the economy. Lower wages means that a lower amount of taxes is withheld from paychecks right away. So that's all for today. Please like, share, and subscribe to this channel for more videos. And I welcome you to my Telegram group and Telegram channel to discuss your doubts. I am very much indebted to you for watching this video, and um, I think you will be supporting me in the future as well. So thank you for watching.